Welcome back, investors, to Ticker Time News. I am Adam, and today is the perfect example of how efficient the options market is. During yesterday's live stream, I made a bold statement that today's market will be green by at least 0.5%. And that's exactly what we got. The options market gave us with the weekly expected move. The two purple lines here on your screen. Here's the top, and here's the bottom. Yesterday, the candle closed outside below this purple line. What did it do today? Today, it gapped up and closed above the bottom purple line. So within these two areas right here is where the options market told us that by Friday, by the close Friday, somewhere within this range is where the market would close. And it's exactly what we got. And this prediction is right 68% of the time. 68% of the time. And you can expect the options market to be right 68% of the time. It's just amazing, isn't it? For this market that wants to take every penny from you, nothing guaranteed. This is as close to guaranteed as you can get. 68% of the time. If you won 68% of your trades, you would be profitable. So that's what happened, and this is the perfect example to show that. Now, for investors on Patreon, you can expect, and let's just hop over there real quick, you can expect to receive the weekly expected moves for the main indices and all 11 S&P 500 sectors every Sunday night from this point going forward to help you make better informed decisions throughout the week. And if you're not a member yet, that's all right. You can get this valuable content and so much more by clicking on the first link in the description or the pinned comment, the link in the live chat. Okay. Buying interest today totally won the day, especially this morning, right? Let's go to the 15-minute chart after I clear up a few of these green marks here. And then I want to go to the 15-minute chart and show you this. But again, while I'm cleaning this up, I mean, it's just amazing at how efficient the options market is in pricing in where they believe the market will go. So you can see this right here. There are 3 sections on your screen right now. I'll break it up, and you can see the volume candles at the bottom to help break it up as well. This is the end and then the beginning of each day. So today, we have this gap up right here, right? And this gap up, it wasn't just any gap up. It gapped up to be within that weekly expected range. So down here yesterday afternoon, I made a small little trade going long just to make sure to test this theory. Before I go and start sharing this, I want to test it, back test it to make sure it is truly efficient and provides value for you watching. So yes, I bought in here. I thought it would bounce. It looked good, right? Even though momentum was getting a little bit weak here on the MACD, I still wanted to test this theory of it bouncing and getting back above the bottom of the weekly expected move. And sure enough, it did. It opened up this morning, gapped up to be within there, right? Now, the economic data that came out today, I don't think it was this bullish. And we'll talk about that in a moment too, for why did the market move like it did today. But most of the action took place in the morning, really. Once you were at 10:30, that was it. The market just moved sideways from there on out, which of course got it back above that weekly expected move on the bottom. So yes, we're going to publish this every Sunday for our members, our investors on Patreon, so you can benefit from this data yourself. All right, moving forward. buying interest did pick up today, and it built on yesterday's rally. The main indices closed considerably higher, with the Dow Jones leading the pack. Surprisingly, I thought maybe tech or small caps might have won the day today, but no, it was the Dow Jones, and it was up 2.2%. Despite the strong finish, though, excuse me for the bump, the Dow Jones still lost 0.2% for the week, while the S&P 500 was still down 0.9% for the week, nearly a full percent there. So the rally that we had yesterday and today, it's a good thing. Otherwise, the markets would have been down significantly for the week. Now, the buyer conviction was fueled by the better than expected retail sales data, which showed a 1% increase on both the headline level and when you take out auto sales. Retail sales are not adjusted for inflation. So that is something we need to make sure we're crystal clear on, right? I'll say it one more time. Retail sales are not adjusted for inflation. So the increase in sales, it was largely a reflection of customers or consumers tolerating higher prices. Remember, the CPI increased by 1.3% month over month in June. 1.3% month over month in June. Yet retail sales were up 1%. Got you thinking there, right? So is the glass half full or is the glass half empty? Let me know what you think. So to me, this retail sales data does not change my thesis on the market, okay? All right, let's look at the dollar real quick. We'll go back here to the daily chart, and then we'll pull up the dollar. And remember, you can do this at home. There's a link in the description to TradingView, and I should have cleaned these green spots off here right quick. It's just a couple. Let's get them out of here. I don't like a messy chart. I like my charts to be clean so I can see what I'm doing and see what's happening. Okay, all right, we're going to go to the dollar, the ticker symbol DXY. And that's the US dollar currency index. The right side for the new investors, it'll say TVC on the right for TradingView. Click on that, and that'll show you what the dollar is doing. Now, the dollar, it backed off today, and that helped the S&P 500 and the other index products rally, because when the market is moving up, guess what? The dollar is moving down, and vice versa. And let's do that. I'm going to put the S&P 500 SPX on top of the dollar to show you. Today, the dollar went down. Let me get the highlighter. I pointed this out a few live streams ago. Want to make sure you're following it here, because it can be an indicator for you. Dollar was down today. All right, not much, 0.6%. And what did the S&P 500 do? It rallied over 1%, right? 1.9%, nearly 2%. But the bigger thing here that I just want to point out is the overall trend of the dollar has been increasing. And we kind of had this break right here in April of this year, where the dollar continued to rise as an overall trend. However, the S&P 500 as an overall trend started trending down. So there's an inverse correlation here. When the dollar is strong, the S&P 500 is weak. When the dollar is weak, the S&P 500 is strong. So just something to keep in the back of your mind, something to check and follow, and it can at least help you with finding a trend right now. And of course, if you're watching it on a smaller time frame, 15 minutes, 5 minutes, it can give you a little indication there too of, well, is the market really heading up or not, just by looking at the strength of the dollar. So just wanted to point that out there. we've done it before just to make sure that you are still aware of it and that inverse correlation is still intact. All right, let's take the S&P off of here. Get that chart nice and cleaned, and we'll keep moving. We also got the July University of Michigan Consumer Sentiment preliminary reading, and it was 51.1. The expectation was 49.4, compounding the positive bias, right? The reaction to this may be excessive, since the final reading for June, just a month earlier, was the lowest reading ever on records, dating back to 1978. In addition, the slight uptick in consumer sentiment was due to falling oil prices. All right, let's pull up crude oil. US OIL is a quick way to get you there. WTI crude futures here. Now, here's what we've got. Crude oil, which fell past its 200-day moving average. So I'm going to open it up here just a little bit to make it a little cleaner and easier to see. Oops, I want to get rid of that. Forgot I had the highlighter still. Okay, let's pull this down. All right, here we go. So for oil, this yellow line, the highlighter is on it right here. It's kind of leveling off and kind of flattening now, right? I'll take the highlighter away. That yellow line, that's the 200-day moving average. On the 13th, it bounced off of that. Yesterday, the 14th, it fell below it, but it did close back above it, which gives us a very interesting candle. Whenever you have a candle that has a huge wick on the bottom of it and a smaller wick, either a tiny wick or no wick at all on the top of the candle, and the candle is small on the top of the long wick, might as well just do this, right? Let's just get no sense in doing this. All right, so here we go. This is our candle, okay? Nice little candle there. And we have a wick that looks like this, okay? The candle nice and, it's filled in up here, nice and square for us. The point, though, that I want to make, even though this drawing is ugly, if it has a long wick on the bottom, that's typically a sign of a reversal. You can call it a hammer candle, but it's a reversal candle. And the same thing is true when it is on the reverse. Now, it's not always a guarantee, and we can just, boom, draw a line straight down and put our candle down here at the bottom. So if you see the candle we just made, that means we're at the top, right? And now we're going to reverse trend, okay? With this other one, it means we are at the bottom, and now we're going to reverse trend and head up, all right? So these candles are very important. And quite frankly, even though it's kind of boring and sometimes hard to understand, knowing what different candle patterns mean is just like understanding what a 20-day moving average is. It can really give you an edge, and again, a market that wants to take every penny away from you. So that's what we had yesterday, that reversal candle. And today we were green, up 1.1% for oil, bouncing off that 200-day moving average. So with consumers saying that, hey, wait a minute, we're feeling a little better because oil prices have come down. What if oil decides to reverse and continue its trend upward? Will the consumer still feel bubbly? That's the whole point of, is the glass half full or half empty with the data that we got today? Most of it is, you could go either way with how you choose. Some of it, like the earnings reports, those were a little more fitting for a bullish bias today in the market. All right. So oil has a very strong support line right around that $93 to $95 a barrel. And it's at 97.5 right now. Now, the last time that it was at this level, the 200-day moving average, was back in February, before the war in Ukraine started. Interesting, right? So it settled up more than 1% today and up 8.1% off of yesterday's lows. Despite the factors fueling buying interest, here's another one. The Atlanta Fed GDP Now estimate was downwardly revised again today. Now it shows an expected contraction for our GDP, gross domestic product, of not just 1.2%, like it said last time. Now it's 1.5%. That's a big drop. And remember, when we get 2 quarters in a row of negative GDP numbers, meaning the economy is getting smaller, it is contracting, that is a technical recession. And Q1 of this year was a negative read on GDP. If Q2, which comes out pretty soon, if it's negative, then we're in a recession. Now, many of you know that I personally believe that we are in a recession right now. The big question is, how long will this recession last? And unfortunately, it seems like it may last a while. Now, this is the clearest indication yet with the real GDP number. It's the clearest indication yet that we are in a recession. All right, moving on from there. And to be fair, the positive bias today was also aided by favorable earnings and guidance from several big companies and big leverage stocks. Citigroup is one. Ticker symbol is the letter C. Citigroup was up 13.2% today. That's a big bank reporting good earnings and a good forecast, right? Wells Fargo is another one. Wells Fargo's ticker symbol, WFC. Wells Fargo was up over 6% today on good earnings and a good forecast. United Health, a big one in the healthcare sector, they were up 5.4% today. All of these companies showed big gains today. Citigroup had the best Q2 results of any big banks thus far, while Wells Fargo, which is on the chart right now, they missed estimates, but they noted that net interest income is expected to be 20% higher than it was in 2021. So that's why it was rewarded. Now, United Healthcare, it beat earnings estimates and issued guidance that was above expectations. So looking pretty good, at least on the earnings side there. Now, these names also gave a nice boost to their respective S&P 500 sectors. Look at financials for a read on that. So let's pull up the sectors here. And remember, if you want the 11 sectors so you can have them in your chart, just let me know and I will share this with you in the chat. All right, so on the right-hand side of the screen here, we have got what happened today. And look at that. Everything here is in the green. Now, when we look at financials, because they were a big mover today, I'll go ahead and pull that up because we were talking about them yesterday. We needed to see some things happen in the bond market to help financials, but good earnings can also help financials out, and they did. 3.5% today. Healthcare, of course, was another one. It was up 2.5% today. They closed at the top of the leaderboard. All 11 S&P 500 sectors closed in the green, with counter-cyclical sectors, utilities, they were up 0.2%, and consumer staples up 0.4%, rounding off the bottom of the pack. Now, even with today's underperformance, these two sectors finished the week ahead of the remaining 9 sectors. That's pretty darn good. Then we have the unfortunate. The 210 spread became more inverted this week with the 2-year, and we can look at that, US 02Y. The 2-year yield, it actually bumped up by 1 basis point to 3.13% to end the week. It's finding a little bit of resistance right up here. If I put a line on it, it would probably be about 3.15, 3.16. That's about where the resistance is right now for the 2-year yield. So it's not just running away and going parabolic. It does have a little bit of resistance keeping it down, which is good because we'd like to see this inversion end. Now, the 10-year yield, and you can look at that by going to US 10Y, going a little slow there. There we go. You can see that it is in a downtrend. However, unlike the 2-year, where the 2-year has resistance, and that's where it's at, the 10-year is floating around its support level. So that's a good thing for this inversion with the 210s. We don't want the inversion to get worse, right? So the 2-year dropped notably this week, settling down 3 basis points today and 17 basis points for the week to 2.92%. Now, before Monday's close, and let me mention this real quick while I got it on my mind. You might want to write it down. Before the market opens on Monday, there are a few financials that are set to report earnings. Bank of America, ticker symbol BAC. Now, they were up 7% today. BAC, I'll plug it in here so we can see. So, investors may have been pricing in a bit Bank of America's earnings report that come out before the open on Monday, and that's why they were up 7% today. So on the financials that are reporting next week, you might want to be a little extra cautious because of the jumps they made today. Some may be looking and getting ready to take profits, and you don't want to go into a situation where other investors are jumping out after a run-up. So just be careful with that. A 7% move today, that's a pretty significant move. When you look at the candle sizes on this chart going all this year, there's probably a handful that are 7% or greater. So it's a big move for Bank of America for one day. Then we get Charles Schwab, ticker symbol is SCHW, up 2.7% today, and Goldman Sachs, ticker symbol is GS. They were up 4.4% today. Now, economic data on Monday will be limited to the July NAHB housing market index. The expectation is 66. The prior month reading was a 67, and that comes out at 10 o'clock. It really doesn't hold that big of a weight in the chances of it moving the market. As a matter of fact, really it doesn't matter to the market overall. Now, today's notable economic data included total retail sales, which we talked about briefly earlier, but I want to dive into it just a little bit deeper here. Retail sales increased 1% month over month. The expectation was 0.8%. Now, if you take out autos, the retail sale increased 1%. Expectation was 0.6%. Now, the key takeaway here is that it was a strong enough reading to keep concerns about a weakening consumer at bay, at least for right now. But at the same time, it needs to be acknowledged that these figures are not adjusted for inflation. So they should not be viewed as an exact reflection of consumer strength. I still hold in my thesis that the consumer is weakening right now. Okay, moving on to another economic data point today. Total industrial production. It decreased 0.2% month over month in June, right on expectations. Then the capacity utilization rate, it also decreased to 80%. That was right on the mark for expectations. The key takeaway here is that total production was weighed down by the second consecutive month over month fall of manufacturing output. A continuation of this dynamic would be viewed as a negative signal about the strength of the manufacturing sector. So we got to keep our eye on manufacturing. It's not looking too healthy at this moment in time. Then we had the preliminary reading of the University of Michigan Index of Consumer Sentiment for July. You know, everyone likes to look at this one. It actually rose to 51.1. The expectation was 49.4 from June's final reading of 50. So it increased. But 1 year ago, the reading for July was at 81.2. So quite a big difference. The takeaway here on this one is that the slight improvement in sentiment was completely owed to a dip in inflation expectations after the recent pullback in energy prices. While any improvement is a welcome sign, this one could be reversed easily if energy prices rebound. And we talked about that. It's looking like it could. Okay, do me a favor before we get to your questions. Click that like button, share this video with a friend, and join us in beating this crazy market by clicking the first link in the description. Get instant access to weekly expected moves, trade setups, top 10 stocks list in 4 different categories, pre-market insights, and much more to help you along your investor journey to becoming what we all want to reach, financial independence. So click the first link in the description, get instant access. We'd love to see you there. Oh, and if it's your first time watching, click subscribe. If not today, hopefully I'll earn it in the next video or 2. All right, your questions for today. Where should we start? First thing that I want to say before we jump into the questions is the weekly expected move will be posted on Sunday. So I do not have what the weekly expected move for the options market will be right now for next week. If I did, that would be pretty darn cool. So I don't at the moment. What I could say is the weekly expected move has been bouncing around. If I were to guess the weekly expected move tomorrow, I would say, or weekly expected move for next week, I would say that both the bottom line and the top line will be lower. That's at least my speculation. I have to look into the options market to find out for sure, but that would be my guess, right? Because overall, the market is pulling down, right? All right. God, I bought NVIDIA calls and barely made money. Then it ripped face during power hour. Oh, wow. Let me just put in NVIDIA real quick. NVDA is the ticker for that. You really like that NVIDIA one. Maybe what I can do is do a weekly expected move for NVIDIA, because NVIDIA definitely has enough volume to do that. And that's one of the key things to getting this right is high volume stocks. It can even be applied to Bitcoin or Ethereum. Other altcoins, not necessarily, because the volume can be too low at times. So big deal is volume is a key to it. With NVIDIA here up 2.5%. Yeah, holding that. And look at this resistance area building here. Actually, let me open this. All right, the chart is going to look a little funny for just a moment. I want to open it up here. And I want to see. It looks like NVIDIA is bumping into an area of resistance. And that's what I want to pull up here and see. So yeah, look at this. So let me get the Sharpie back here and do this. So if we go back to once we broke this level here, right? And there's a lot of investors and traders trapped in this area because the market just fell, and it fell suddenly, right? Since falling here, NVIDIA has not been able to break back above its 20-day moving average. And that's exactly what happened today, right? You can see in there. So we have an area here of resistance about where this red line is going across the screen here. And it seems like the middle of that is about 170, okay? That's a real strong area of resistance. And we also can go back to this area over here to see that. NVIDIA is finding support along this line coming down here. But also price-wise, we could put in probably right around this 145 area as well. Seems to be holding up as a support area. And then where I have this blue line here, right at the 20-day moving average at about 157.8, that's a resistance area, right? For NVIDIA to be bullish and to throw a call option in there for NVIDIA, what you'd want to see on Monday or sometime next week is it break above this $57, $58. And as a matter of fact, you'd want to look at July 7 and July 8. NVIDIA needs to break above those two levels. And that was a high of 159 and a high of 160. That's an area of resistance right now for NVIDIA. 159, 160. Okay. So if it can break above that, that is a bullish move, because if it did that, it would also be breaking above that 20-day moving average. Then what you'd have to watch for is at 170 resistance. All right. So you could get an opportunity where NVIDIA does break this and it gets up here to the 170. It gets rejected off of that. It back tests that 170, doesn't break through. That's when you can go in, load up on shorts, get puts in this scenario, and ride it back down. That would be an area that would interest me in shorting NVIDIA right there. That exact scenario. All right, clean the chart up here a little bit. And guys, I greatly appreciate each and every one of you for being here. If you do have a question, just slip it in the comments and we will go over it. Okay. Nice benefit on Patreon. Yeah, I think it will be. I think it will benefit everybody. And then, of course, I'll have it on the chart during our live streams. But yeah, it'll be real helpful indeed. And actually, I'm going to make a note here. I'm going to do the weekly expected for NVIDIA as well. Just want to write that down so I don't forget. Okay. What would cause the dollar to pull back? Well, the dollar right now is extremely, DXY is the ticker for that. It's extremely oversold right now, big time. And if you look, remember we were talking about reversal candles. Well, the candle that was made yesterday, it's got a pretty decent wick on it, which is right up here. And then there's no wick at the bottom. That's what would signal a potential reversal. Now, look at how far away the dollar is from its 20-day, its 50-day, and its 200-day moving averages. That is just incredible. It is really, really extended right now. You look at the RSI, it's over 70, and 70 and above is oversold. Then we look at the MACD. You can see the momentum. We got this darker blue, and then we have a lighter blue. That's showing us that right here in this area, momentum started to shift, and it's starting to curl over on the MACD. Not quite going down yet, but it did start to curl over. So those are some signs right there that tell me just technically the dollar is way oversold at this moment. Now, there could be a whole bunch of reasons for causing this. As a matter of fact, I did read one today. I can't remember all the details that were in it. It was on Seeking Alpha. And it was talking about the US dollar. As a matter of fact, can I pull that back up? Let's see if I can real quick. So what would be an expectation here is much like oil has pulled back significantly. I would not be surprised if the dollar did some dancing on the way down here, maybe to that 20-day moving average, find some support there like it did back here and like it did all through this area right there. That would be my number one expectation for where the dollar could pull back. And if the dollar did that, well, remember, that would provide a little bit of fuel to the S&P 500 and other equities to rise. All right, let's see if I can't find that one again. Oh, strong dollar is flashing a warning of a credit event from Bank of America. All right, let me pull this up and pull this over. This is an interesting one. All right, let me pull it over here. There we go. Okay, so let's see here. The recent strength in the US dollar is raising the probability of a further shock to the economy beyond recession, according to Bank of America Securities. The dollar index is up more than 7% year to date, and it is, we can measure it and see that, and has broken through parity with the euro. That's true. We talked about that either earlier this week or last week when it occurred on a live stream, as the Fed remains aggressive in its tightening compared to other central banks. All right, emerging market currencies have come under. All right, I don't want to read too much about emerging markets. Bank of America and Wells Fargo are both talking here. In many cases, despite global equities in bear market territory and the risk of a global recession elevated, currencies have yet to approach the upper bound of their segment's potential range. And that is from a note on Friday. All right. A spiking greenback, which is a dollar, often portends a credit event, as it did in 1998, 2008, and 2020. Bank of America strategist Michael wrote Friday in his weekly flow show note. As intense central bank hiking cycles is a risk for the current consensus of a shallow recession and, quote, fresh big rate hikes as central banks play catch up in coming months, risks recession shock morphing into credit event. That's very interesting. Now, on the chart right here, you see global central bank hikes, right? They are raising them very fast globally. So the amount of banks, central banks that are raising rates, what is this up to, like 40 or above? When like historically we might be around 10 to 15. Let's see here. Liquidation, deleveraging, and default. Well, that sounds like the cryptocurrency space, doesn't it? Liquidation, deleveraging, and default. Those risks are high in areas like private equity, venture capital. See the chart for that. A peak in the dollar in Q3, absent a credit event, is the best path for a year-end rally in distressed cyclicals. But investors have to pick which FOMC meeting, September 20, November 1, or December 13, to flip their portfolio before. So what they're saying here is that one of these FOMC meetings, the Fed is going to pivot, causing equities to start rising, meaning a bottom in the stock market. And I do find this November 1st one very interesting, because if you know, for me on the SPX, and it even can line up on the SPY, I have a very particular target down here. Let's get this tightened up here a little bit so you can see where it is at. All right, come on. All right, stop lagging here. Let's go. All right, there we go. Finally. Okay. All right, that red box filled in with yellow. That's a target of mine. I've had it there since day one. And it's in October, third week of October. And it is sitting, middle of it would be about 32.75 on the S&P 500. That's where I think the market's headed. And if you look at this, if they think that the Fed may pivot on the September, November, or December meeting, that would show a bottom and equities would then rally. Now, they do put one little caveat here. We think November, unless market melts down, and oh, that is crazy. So they're picking November right here, unless, one little caveat, unless the market melts down in the next 8 weeks, right? So if the market over the next 8 weeks, and this is the daily view, so that would be 2 months. If we go here, July to September, which is somewhere like right around here, as long as the market doesn't melt down between now and that time frame, then they're picking that November meeting, which means the end of October, that would be the bottom of this potential bear market, right? And then we can start digging our way back out of it. That is very interesting. Then they say here, for the broader market, Bank of America still says nibble at S&P 500 at 3,600, okay? You can take bites at 3,300, and you can gorge out at 3,000, all right? And where did I have this box at? Right here. The middle of it is about 32.75. 32.75. So that would mean they say you can take a bite at that moment in time. That that is interesting. That is very interesting. Okay, CY traders are back in the 75 basis point hike camp today. All right, that's the end of this little note right here. But you know, I do find it interesting. This last chart right here, it says credit risks from SoftBanks. We have a big spike February 16, a big spike March 2020, and we're in a big spike right now, July of 22. Interesting. Very interesting. Okay, let's move off that. And what else do we have here? Sold a few calls a little too early. Yep, just a little bit. Just a little bit for selling those calls. When price action gets outside of that, on the bottom of that weekly expected move, then you could do a call, because most likely, at least 68% of the time, it's going to go back up and at least close above that line or on that line. And sorry I missed that earlier. Okay, about the dollar there. How bad could it get if almost all these companies start reporting bad earnings and guiding down nonstop this whole month? Okay. My target down here, okay, right down here, this guy. The thesis on this is that phase 2 of this bear market is an earnings bear market, where basically the majority of companies are coming out and they are downgrading their forecast. They're downgrading their guidance, whether it be for the next quarter, year end, or into next year. That's what my thesis is on, and why I get down to this level on the S&P 500. I don't think it would be a straight fall, right? Because if it is, then my line's not matching up here. I do think it would be an aggressive fall, right? We have been, since the end of the March rally, the March snapback rally, we have been falling pretty aggressively, but not straight down. We get a bear market bounce and we fall aggressively. Bear market bounce, and we didn't really fall aggressively this time. We're kind of on that bear market bounce right now. So it's just, I want to move, not that. I want to move this one out of the way. So what we would most likely then see is a continuation of this, you know, fall aggressively, but not straight down, you know, have a bear market bounce within this. Maybe not as aggressive of a bear market bounce, and then, you know, continue on down to it. So not super aggressive, not straight down, but aggressive, an aggressive fall. That's what I would be thinking if the majority of companies come out bad earnings, and they don't have to necessarily have bad earnings. They can have a beat on EPS and revenue, but if their forecast, if their guidance is what's down, then that is what puts falls into my thesis here for how these markets could react and get down to this level down here of 32.75. by October. So again, we have time, and there will probably be bear market bounces all within it. All right, sorry I missed over there. Are you trade options? I do not trade options with anything mentioned on Patreon. It's really, we have a, let me just quickly just pop over here and I'll just go over it. So pre-market insight, we get the post-market live stream like we're doing right now, where I run over what happened in the market, why it happened, and what to prepare for next, and answer your questions. That's the biggest part. We get top 10 growth stocks, top 10 dividend, top 10 value stocks, constantly updated a couple times a month. Stock ideas, weekend perspective, kind of like a recap of what happened this week, or the week that we just got through. Weekly expected moves on the indices and the S&P 500 sectors. So that's 11, 12, 13, 14, that's 15 weekly expected moves for 15 different products. And I'm going to do one for NVIDIA this week, weekly expected move. And if you have a company you want weekly expected moves for, just send me a little note. And if they have high enough volume, so it can't be a real small cap company, they have to have good volume, good liquidity, and then the options market can give us a running through a formula. They can give us a weekly expected move for a individual stock. And then we have top 10 momentum plays, economic data reviews, buy sell alerts for Bitcoin, Ethereum, trade setups, and we give you a good selection of different trade setups there for our members over here. So there's a lot of good value, but we do not do options over there. Let's see here. FTNT and QCOM, absolutely. Qualcomm's been doing okay. I'll start with Qualcomm because I'm more familiar over here. You are very welcome. Absolutely. All right. Now 1.7% move to the upside today. And quite frankly, all right, let's get this chart in here the right way. Open it up. Let's go. Let's go. Okay. So we are definitely in this, bear market. We're in this downward trend right here. But I'll pause it at that moment, because what we have right here is we've got this low right here, right? And then we have a higher low and a higher low, right? We're also getting higher high, higher high, and higher high. If our next move down creates a higher low, we may have an actual trend reversal here in the short term. And that would kind of be pretty bullish. Right now, we are above the 20-day moving average, and that 21-day moving average has already curled and is now pointing up. That is bullish right there. Earnings are coming up in 12 days, so that's going to play a role. It looks like there is support right here around the 129, 130 area. And it looks like there's going to be some resistance. It looks like, let's see here. This last rally right here. And let me change that color so you can see it. To be really bullish on it, price is going to have to break above these, the highs that were made back here. This will be at the beginning of June. And it looks like they're sitting right around 144, 146 in that range. So it's right there right now at 144. If it can break that 145, 146 and keep moving up, that is also bullish. So I'm seeing a lot of bullish characteristics here on the chart. And then the next area that we need to be watching out for is about the 153 to 155 area up here. That will be resistance as well. We have the 200-day. It is kind of flattening out in this area right here. So that will be an important one. So a breakout above 147, and we could get a run all the way up to 153. I know it's not a huge move. As a matter of fact, if I measure that, where we are right now, 144, up to that area, well, you're looking at a 6.26% move. 6.26% move, breaking up above 147 and then getting stopped right here at resistance at 153. That could be a good play going into earnings if you're really to take on a little bit of additional risk because of earnings and the potential for downside guidance during earnings. And that could bring the stock right back down. Personally, I would not play during earnings because there is a really high probability that the guidance could be a bit soft, a bit weak, and that could bring the stock back down and kind of change this little reversal that we have right now, if that makes sense. Hopefully that makes a ton of sense there for you. Actually, let me just do this. I should have done that already. All right, let's look at, well, let me clean this chart up first. I do not like to leave my charts messy. I want them nice and clean and crisp so we can see what we're doing, see what's happening. We'll go to FTNT next. Just a couple more clicks, and then we have it. All right, FTNT. All right, so we right off the bat, I see a bit of consolidation going on here. All right, we're moving sideways. That's what we're doing here. We're moving sideways, but it does look like it could be potentially turning a little bullish at the moment. A big support at this $51, $52 area. Let's get that highlighter back out. And you can see that. Bam, it tagged it there. Sank below it there. It tagged it there. It tagged it right in here. So that's been a good area of support right there. And again, that's the 151, 152. Now, we are pretty much just, if I drew a line through here, we're pretty much just trading sideways, right? So when we get to this 52, 51 area, as long as it doesn't break down and it bounces here, then we could, call option and go long on this and, ride it up. I'd probably ride it up to that 200-day moving average, which right now is trading right about $62 or so. And maybe I'd take, 2/3 or maybe just take a third of the profit. See if it can break through that, because if it can, then I'd ride it up to, maybe a next level up here, maybe around 168. Take another third of my profits on that one, or just close out the position because we know it's getting pretty darn high at that point. And then on the opposite of that, if it does get up into this upper area here of $68, $67, put option, right? and then you can ride this baby down. You might find a little support on that 200-day moving average again. Maybe take 1/3 of your profit off the table. If it breaks it and keeps falling, well, when it gets down to a certain area that you're comfortable with, take the other 2/3 of your profit, and you've made yourself a nice trade on this trend. So that's the first thing that I see. The second thing that I see is that it is currently getting stopped at its 200-day moving average. All right. Just cleaning up the chart just a little bit here. All right, almost got it. A couple more clicks and it'll be clean. All right, so the 200-day moving average, right? It's running right along here. It stopped it there and it hit it here and got rejected. Now it is trying to use its 20-day moving average down here as support. So what is this price doing? Well, the price action is starting to tighten up. So we have expansion, right? Straight down there, expansion, back up, expansion down, expansion, expansion, expansion. Where's the contraction? That's what we really need to see here. That's what's missing from this picture are areas of contraction right now. We had contraction back here. That's healthy. That's good. Because contraction leads to expansion. And then expansion leads to contraction. It's a cycle that always plays out in the market, but we're not really seeing that contraction here. Although price is starting to tighten up a little bit. I mean, we could probably get a wedge in there, but as long as it is sticking below the 200-day moving average, you know, this is more worrisome that it can't break back above that again. And then you have price action here getting tighter and tighter and tighter. So we had, and let me just do this to make it a little easier. We had expansion, right? And then we could kind of say that this right here, price action tightening up, is the compaction or contraction, excuse me, the contraction phase. And if that's the case, then contraction leads to expansion. So what is it going to do here? Is it going to break out to the upside or is it going to break down? What we would need to see is we would need to see volume rise for a break to the upside. And right now, we're just not seeing volume. It is staying under the median average there. It's low, right? We have the RSI. It is barely above 50, just starting to kind of curl over. But we've got this bearish move here on the MACD that says this thing is going to go lower before it goes higher. All right. So there's some technical thoughts there of the chart for FTNT. We'll keep moving on. You are welcome. My last question is, what do you think of healthcare stocks for the long term? Let's just throw that there real quick. You are welcome. I'm totally glad that I was here. You were here and we're able to get this worked out. Okay, healthcare sector. Almost got these lines off. Okay, So we got two areas we can go. I'm going to go with there we go. I'm going to go with XLV. Which is the Spider Select Fund Healthcare. I think long-term healthcare is a great one. Baby boomers are aging out. Healthcare is going to continue to grow. If you see here, just for 2022, what has healthcare done? It's just moved sideways. So if I pull this up a little bit, I want to go look at yearly here. It's down 7.8% year to date. This past week, it was up 0.17. The past month, 7.4%. So it's made a nice move. But right now, it's running into its moving averages right here. It's running into an area that is sticky. It can act as support, resistance. So that's two short-term things that say, you know what, maybe it's kind of tapped out here, and maybe it's going to just head down. Because if I take that line away, what do we have here? We have lower high, lower high, lower high, lower low, lower low. I mean, it looks like healthcare could just continue its rotation down and come find support down here. That's a short-term possibility. Long-term, I can see logically, let's go to a weekly time frame here. Healthcare needs to make a move up. Right now, you can see it is just moving sideways. It's got a support area. And if you want to go to an area, 2018 into the beginning of, or the end of 2019, for about a year there, it moved sideways before it started to break out. Then COVID hit and hospitals started closing down, not doing the elective surgeries or selective, whichever word they use. I don't remember at the moment. Hospitals need to get back on track. Right now, hospitals are unorganized, a lot of them. My sister is actually a nurse at a local hospital here in Northern Virginia, where we live. And hospitals are stressed. They're unorganized. They are burnt out from the pandemic still. It's not a good situation. And unfortunately, if I put my futuristic hat on, if healthcare becomes a human right here in the United States, and it is something that is taken over by the government, then these burnt out and inefficient, unorganized hospitals could start collapsing or being transferred to the government. So that futuristic hat, it doesn't look good. But if these hospitals can use this recession to reset itself, find its footing, and listen to patients. It sounds so simple, but sometimes it's hard to do. Then hospitals have a bright future. So there's a lot of things at play here when it comes to the healthcare sector. I do think, since healthcare has, basically It's been flat. It's had its moments in 2022, but overall, it's been pretty flat. I think it's looking for a way to move up, and I think it could. When you look at all the all the sectors, and you look at them on a weekly time frame, a real big time frame, you can see on some of them that there is a rotation that is starting to occur. Unfortunately, I don't see it here on healthcare yet. To me, it just looks like it slipped right through its support, and now it's coming back up through it, and now it's tapping into its moving averages, the 20-day, the 50-day, and it doesn't have enough momentum to get over that yet. I mean, volume is so weak. We need to see volume come in and get above average and push above these short-term moving averages in order to potentially, because if you look here, what do we have? We have a high. A few months later, we have a higher high. A little later, a higher high. So it is possible. And on the bottom side, it's basically a flat straight line. I'm not really good at doing a straight line here, but we've got some building momentum here on the tops. That's bullish. All right. Innovation is also something that is in the healthcare industry that will be a lifesaver to the inefficiencies that are in hospitals today. I'll end on that note with healthcare. Oh, sugar! I should have done this because that's what we were talking about. My apologies for not putting the question up on the screen. Okay. Any other questions, or are we good for Friday night? A lot of good things coming to our investors on Patreon. Back at the beginning of the year, when I really started putting benefits together for our investor community on Patreon, there was one thing that I really wanted to do, but I just was unsure about how to set it up, and that was a Discord. So if you could, just let me know. Just send me a note. Say, we love Discord. That would be a helpful benefit. I would set it up if that is the case. So just let me know if you think Discord would be a benefit. And if it is, I'll get it done. I'll figure it out and get it done and get that set up. I can understand technology to a certain degree, but Ticker Time News is actually already on Discord. I just wasn't quite sure how to officially link it up and get it going. But I see it. It would be great. Okay. All right. All right. So I'll start working more diligently to get a Discord set up. I'll do that. I will commit to it. I know I broke the promise at the beginning of the year. I apologize for doing that about the Discord. I just got to a point where I kind of like threw my hands up, but I'll push through that. I'll figure it out, and I'll get Discord set up. I'll follow through on that commitment. All right. Discord. All right, so no other questions. Well, we'll wrap it up here for tonight. Greatly appreciate your time here with me. I love your questions. I love diving into the stocks and stuff you're interested in. One last thing I want to point out, and as a matter of fact, I pointed this out just real quick in the note that I did send investors about this week. At the bottom, I put a little note down there, just a real quick couple sentence note about the crypto space, right? Well, you know, Bitcoin is stuck to that 20,000 level. It goes slightly above it, it comes right down slightly below it, back and forth it goes. This is a weekly time frame here. So for the week, you know, Bitcoin did pretty darn good, but Ethereum blew it out of the water. Let's see here. Published. I want to pull up that note real quick. Ethereum just did a fantastic job this week. And Ethereum is really stuck between 1,000 and 1,100. It's like glue. Just like 20,000 is glue for Bitcoin. Let's see here. The last thing I said was Bitcoin finished the week about where it started, with a 0.4% gain. Bitcoin is holding at the 20K level and consistently swinging above and below it. Ethereum had a much better week, gaining 7.69% and continuously holding above the 1K level. So those are two good developments there for Ethereum especially, and Bitcoin. And if we look here on the weekly chart for Ethereum, we still have one more day to go, because unlike the regular market, crypto market is open 24/7. So we got to wait to Saturday night. But this candle looks like it's going to stay within its bearish rectangle here, which means it's basically moving sideways. It's contracting, right? Expansion, right? Expansion leads to contraction, which leads to expansion. So that's what I think could be going on, or contraction to expansion to the upside. But anyways, that cycle of contraction, expansion, it's playing out in crypto right now. It is a bearish setup right now, even on Bitcoin. Put Bitcoin back up here for the weekly. And again, it is just moving sideways. That is a bearish rectangle. Expansion, contraction, then I think expansion would be down a little bit for Bitcoin. I think it's got another level to drop. And unfortunately, you know, that level, you know, it could get down to 11,000 if it really fell hard. I'm thinking 16,000 might be a base, but I'm just saying the possibility is there. But I think the probability is higher that it would stick around this 16,000. All right, ladies and gentlemen, thank you again so very much for being here with me. I will work hard on the benefit of Patreon. I'm sorry, Discord. And that's it. So have a wonderful weekend. I'll be back here after the markets close on Monday. And to our investor community on Patreon, I'll be talking to you in between there. All right. Take care and have a good night. See you in the next one. Bye-bye.